Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menasce. Today we're talking about a topic that sits at the heart of every real estate transaction, and yet it's often misunderstood by investors, by borrowers, and even some professionals in the industry. We're talking about the difference between collateral value and equity value. At first glance, it might seem like a property has a single value. After all, if someone asks what is a building worth, we tend to quote a single number. But in reality, the answer depends entirely on who's asking the question, why they're asking, and the context. A lender looks at value very differently than an equity investor. A bank underwriting a loan is not trying to determine how much money you're going to make. They're trying to determine how much money would they lose if things go bad. An investor, on the other hand, is interested in the future. They want to understand the upside potential, the risks, and the expected return on their capital. The same property can have two very different values depending on whether you're evaluating it as collateral or as an investment. So let's start with the collateral value. Collateral value is fundamentally a risk management exercise. The lender wants to know one thing above all else. If the borrower fails, can the loan be repaid through the sale of the asset? That's it. A lender isn't interested in your vision for the property. They're not interested in your development plans, your operational expertise, or your hopes for the future. They're interested in the property's current ability to support the debt. This is why lenders often rely on stabilized net operating income, market rents, and very conservative occupancy assumptions. Suppose you acquire an apartment building that's only 70% occupied. You might have a detailed business plan to get to 95% occupancy over the next 18 months. An equity investor might get excited about that opportunity to create value. A lender may not. A lender might value the property based on current performance or on a stabilized income level that might be supported by market evidence. They'll typically discount projections that have not yet been realized. In essence, the lender is asking, what is this property worth if everything doesn't go according to plan? Collateral value is designed to withstand adverse scenarios. That conservative approach becomes particularly important during economic downturns. We've seen numerous examples where investors paid prices on aggressive assumptions, only to discover later that the collateral value was significantly lower than the purchase price. And when markets soften, lenders don't care what you paid. They care what the property is worth today. So let's look now at equity value. Equity value starts where the collateral value ends. An equity investor is focused on the future stream of cash flows and the potential appreciation of the asset. They're willing to take risk in exchange for reward. Consider a vacant office building that might be converted into residential apartments. A lender looking at that building today might see a struggling office property with declining occupancy and uncertain demand. Collateral value might be tiny. An investor might see something completely different. They might see an opportunity to create hundreds of apartments, generate substantial future income, and produce significant capital gains. The investor's valuation incorporates future possibilities. In many development projects, the gap between collateral value and equity value can be huge. Let's use a simple example. Imagine you buy a piece of land for $1 million. Today, the land is vacant. It might only support a modest loan. The lender may conclude the land's collateral value would be indexed to the current market value of $1 million, but they may even discount that by 50%. Suppose the site has its potential to support a 100-unit apartment building. The investor might calculate that the completed project would be worth $25 million on stabilization. The investor is not valuing the dirt. They're valuing the future income streams that can be realized on that dirt. These are two entirely different perspectives. Neither one is wrong. They're just different. One of the biggest mistakes investors make is confusing these two concepts. I actually call this the chicken and egg scenario. Now, this is not the chicken and egg scenario you're thinking about. In my scenario, we're talking about an egg that may at some point hatch and grow into a full-grown chicken. Its value today is as an egg. The value might hatch, it might not, we don't know. It might grow into a full-grown chicken. Valuing it as a full-grown chicken or even any bit of a percentage of a full-grown chicken makes no sense when you're looking at it from a collateral perspective. And while the egg has potential, it doesn't exist as a chicken today. So a lender advances capital based on the collateral value, not the aspirational value. It's based on the value of an egg, an unhatched egg. And that's why equity exists. The equity fills the gap between collateral value and the future project value. In a development project, equity investors absorb the development risk. They provide the capital necessary to create value that doesn't yet exist. Only after the value is created does it become collateral that lenders can comfortably finance. That distinction becomes particularly important during refinancing. Many investors assume that once a project is completed, they'll automatically recover all of their invested capital through refinancing. But the refinance amount depends on the lender's view of the collateral value, not the investor's estimate of future upside. If interest rates rise, if cap rates go up, if operating performance falls short of expectation, the refinance proceeds will be lower than what was originally anticipated. Understand the difference between collateral and equity value helps investors structure deals more intelligently, helps explain why appraisals often come in below expectations, and helps explain why some projects generate tremendous returns even though they appear marginal from a lender's perspective. At the very core, real estate investing is about creating a spread between today's collateral value and tomorrow's equity value. The greater your ability to create and realize that spread, the greater your opportunity for creating wealth. As you think about that, have an awesome rest of your day. Go make some great things happen. And we'll talk again tomorrow.